Asset is New Zealand's trading platform for digital assets. We have over 50 different currencies trading on our platform, crypto assets, along with New Zealand dollars, euro, and US dollars, among other stable coins as well. And we are also in Australia. So, if you think about in the future, what will we have more or less of? And, when we think about digital assets, what I think people often think about or forget about is the direction that we're moving in the world. And, we're at a point where the new oil is data, and there's so much that's happening digitally, especially when things like COVID occur, which push everyone a little bit further away from each other physically, but a little bit closer to each other in the digital world. And that's not stopping or slowing down by any means. If you look at companies like Amazon, they're exploding in value right now because of e-commerce and the ability to shop online. That, even in New Zealand, we've seen an enormous growth in the online shopping over the last quarter, despite the economy overall going down. And so it's really important to think about, if things are moving into a digital world, why can't value and assets do so as well? Over the last 10 years, I've heard a number of arguments against Bitcoin and crypto, and they're oftentimes the same arguments, and they're oftentimes very very vanilla in terms of their thinking. And I often hear this by a lot of reputable people who have made a name for themselves in the financial industry, bankers, lawyers, accountants. I've heard some of these arguments by a lot of people over the last 10 years. And I think a lot of it is a lack of education, or just a lack of wanting to understand what this industry is really about. And so the first one, we don't really hear that much anymore. It's how in the world could this thing have value? It's not backed by the government. Well, that's one thing that we've seen, and I'll do a comparison of currencies between current currencies and cryptocurrencies in a minute. But even though digital assets aren't backed by government, they are have a market of voluntary exchange. They've somehow materialized this value, this price, even though they aren't created by any government. And so another argument I've heard is that it's not tangible, you can't touch it, so how could it possibly have value? It's not regulated, and the technology is not scalable. So I've heard all of these a million different times, and oftentimes it's a lot of the arguments are quite nuanced. So it's not tangible. So yeah, Bitcoin itself is not like coins in your pocket where you can't feel it and touch it with your hands, but it is backed by one of the largest distributed computing networks in the world. And that physical infrastructure that is auditing and securing the network is very tangible. Not that that has any relationship to the value of Bitcoin or any digital asset, because the value at the end of the day really is derived through its utility and speculation, not necessarily from the physical hardware that's backing it. And so, when we look at regulations, we see within New Zealand, there are lots of guidances and regulations around digital assets. The IRD has, if you go to their website /crypto assets, they have many guidelines around how digital assets should be taxed, how you can get paid in salary with digital assets. If you go to the DIA, they can show you how VASPs or virtual asset service providers like DASSET should do their compliance obligations and the regulatory requirements that they need to go through. And so there's enormous regulatory both discussions and implementations, not just in New Zealand, but all around the world. And the scalable one, you know, is definitely a valid point. But, you know, when you think about this as a new technology that's doing things in ways we've never done before, then you understand that really this, you know, that we have a long way to go, and this technology has a lot of potential growth, and there's a lot of solutions being pushed forward to solve a lot of that scalability. So even though it's not scalable, in terms of being able to do millions of transactions a minute or an hour, it's getting there. Over the last 10 years, over 30 trillion New Zealand dollars in value have transferred on the Bitcoin blockchain globally. 80 trillion mass problems per second, that's the physical computing network that's securing the network, are doing mass problems or hashes per second. That's an enormous amount of infrastructure that's there behind the network. And Bitcoin remains the most decentralized collaborative project in the crypto space. And so, you know, this is where we start looking at how digital assets can protect you. And you look at other national currencies and they often come up against different geopolitical issues, and also have issues like, you know, sanctioning and manipulation of the prices of those currencies, which are really political manipulations. And so you have a lot of uncertainty and risk in that environment, where digital assets are quite collaborative. You know, the Bitcoin network has people in Russia, China, the United States, the UK, Germany, Chile, Philippines, New Zealand, all working together on this network and this protocol. And so it really is borderless in terms of the collaboration and the people who are working on this. And so it kind of creates that hedge against geopolitical risk, where even if there are meltdowns in political you know, policies globally, holding digital assets or crypto may prevent you from having being impacted by those political issues. And so, you know, when we look at what the government's doing with crypto, we also see the enormous amount of interest and innovation. You know, New Zealand just passed or a framework for digital identities using the technology under crypto. And we're seeing a lot of electronic voting initiatives, especially with a lot of talk about, you know, voting fraud and mail and ballot fraud, and you know, people bringing up some of these topics. And so so another area that we see is people can compare currency to cryptocurrency. And that's because we made the big mistake of using the word currency in the nomenclature of crypto. So if you compare apples to apples, what you'll see is that cryptocurrencies and Bitcoin have very little resemblance to modern day currencies. And so here's a great example. So current day money is issued by legal tender. And so it's usually issued by a central bank. Sometimes it's issued by a treasury of a government. Those central banks are a mix between being private and public, either owned outright by member banks, the government, a mix of in between. And usually when new currency is created, it's created out of debt. And so the government creates new debt, and the Reserve Bank or the central bank issues new currency against that debt. And that's how we create more money in a modern monetary system. And so modern currencies are inflationary. Inflationary as in their supply tends to increase every year. And the reason why the supply tends to increase is through the monetary policy of having very loose monetary policy, or we like to keep our interest rates low. So we like to print more money to pay for goods and services that we can't pay for through taxes. And so, so that makes the value of our dollars worth less every year. And so, the currency that we use is essentially, if you think about it as a product, it's monopolized by legal tender. And so, if we look at the value of the New Zealand dollar since 1971, we can compare it to a commodity like gold or silver. Silver has been money for the longest period in human history, nearly 1,500 years. And that's actually where the term dollar came from. Dollar was a term or a denomination for silver, one silver dollar. And in 1971, one silver dollar could be bought for $1.40 New Zealand dollars and $1.60 in US dollars. And today, one silver dollar can buy the same amount of stuff that it could in 1971, but in paper dollar terms, it's worth 44 New Zealand dollars and 23 US dollars. And so the New Zealand dollar has lost an enormous amount of its value, and a lot more of its value than the US dollar over the last 50 years. And that's primarily because it's issued by a central bank that has an incentive to create a little bit more each year. And so if you look at the way that modern currency is issued, the way that its monetary policies are designed, the way that it derives its value, it's very, very different from digital assets or cryptocurrencies. Cryptocurrencies, kind of going back to that not being backed by any government, it is where you start, your jaw starts dropping. You mean it has no backing by any official organization in the world, and yet somehow it's managed to get some value through voluntary interaction, and not just a little amount of value, hundreds of billions of dollars. And that's absolutely incredible, where Bitcoin's not the only kid on the block. There are many, many other digital assets out there. And so there's no monopoly. Anything can replace Bitcoin tomorrow. And so it works in a competitive environment. It's deflationary. We can't come and print Bitcoin out of thin air. It's a scarce resource. Similar to gold, it's bound by the laws of physics, and it's provably auditable. So it has a lot more characteristics to natural resources like gold and silver as compared to current modern monies like the US dollar. And so, gold and silver used to be money. I wouldn't say it's money anymore. It's more a stable or storage of wealth, where Bitcoin's not really money either, but it has that potential and has a lot more attributes to something like gold or silver than things that we use as currency today. So an interesting report by Fidelity came out on Tuesday, and they were, if you're not familiar with Fidelity, they hold about $2 trillion in assets at their fund out in the United States. And they have about 48% of their institutional customers holding some form of digital assets. They recommended that 1% of your financial portfolios held in digital assets, and they're recommending as high as 5%. And so this is based on a few claims, and I don't necessarily agree with all their claims. The big one that I hear a lot is that digital assets like Bitcoin are non-correlated assets, as in they don't correlate with the stock market or the gold market or any other asset. But that's simply not true. Especially recently, over the last year, Bitcoin has correlated quite strongly with both the stock market and the precious metals market. And a big reason why is because of the institutional interest and access to digital assets. Now that the institutional channels are being opened, these institutional customers are playing a much bigger impact on the industry. And so because the legacy financial system's not doing well, when funds need to sell assets, they tend to find the most liquid asset, which is still cash. And so they'll sell everything. They'll sell their gold, they'll sell stocks, they'll sell their crypto assets, trying to seek a safety asset like cash. And so, so in those events, when there is a decline in the gold price or a decline in the markets, we'll also see that decline in crypto. But long term, and this is where it becomes important, is that although might be those short term correlations, long term Bitcoin has far more potential as a hedge against some of these events. And part of the reason why is the reduction in things like counterparty risk, where if there is, say, a financial collapse, you don't know which financial institutions are sound and which ones are not, especially when the banks, for example, the banks in New Zealand have 5% of liquid assets on hand. So, a bank like ANZ may only have 5% of their customer deposits in cash, and the rest are held up in loans. And so, if there's a run on the bank, you don't really know whether the funds are there. And even if the funds are there or not there, you're likely to get a bailout. And what a bailout means is that somebody is going to be printing more of those paper assets. And so if they're printing more of those paper assets, those dollars are worth less. And so that's where crypto is seen as a hedge against certain counterparty risk over that medium to long term. Recently, we saw a number of institutional customers buy quite large amounts and are holding reserves of crypto, including Square and MicroStrategies, which are MicroStrategies is a fund on Wall Street, and Square is a financial company. They do things like payment services and merchant services. Since June, according to the blockchain analytics company, 90% of crypto transactions in North America have been institutional customers primarily acquiring digital assets. And so, so we're seeing a large trend of institutional customers entering the market where they're looking at this as a low, they're not putting all their assets into crypto. They're putting 1% to 5%, and compared to their portfolio, it's relatively low risk with quite high rewards. And so that's the way that they're looking at it. And so, looking at Dasset, the top traded assets on Dasset is Bitcoin. Bitcoin's been that way for some time. Followed by some of these other assets. Ethereum is another big one. I'll go into some trends as to why that is. And then the smaller ones like Litecoin, Ripple, Link. Litecoin is similar to the silver of where if you consider Bitcoin as digital gold. XRP is a digital token that is supported by some banks around the world, and Link is a digital token used for providing Oracle services to the Ethereum blockchain. And so, when we look at crypto, we see nobody can tell you, no expert can tell you what's going to succeed and what's not. We do see some tribalism where people, communities, developers are attacking each other either maliciously or publicly, and nobody can tell you which ones are going to be the winners and which ones are going to be the losers. And so that's where there's a lot of diversification going on in the industry, where people are looking at Bitcoin as kind of that gold, that digital gold. It's much lower risk, but much lower returns, because most of those returns have been captured in the first 10 years of its existence. And looking at other opportunities where there might be new innovations or new potentials for growth. And so, so although most people are holding Bitcoin, they are starting to dabble into other assets. So in the Oceania region, we see most trades happen with East Asia. This is just a graph that shows which areas of the world our region trades with digital assets. And so, and approximately the dollar values. And these are in US dollars. And so with Eastern Asia, and I suspect it's mostly because of things like remittance. It's nearly 10 billion US dollars. And this was for last year, essentially. And within our region, $5 billion, but we're actually doing more trades with Europe, Northern Western Europe, at nearly $6 billion in trading volume between the Oceania region in Europe. And then following that is North America. But there's a lot of potential for growth in places like Africa and Latin America, because crypto gives people the opportunity to engage or interact in those countries and those jurisdictions, because essentially they've been priced out of the bank system. So some big trends we're seeing: lots of corporate coins coming out and lots of corporate announcements. They talk about these digital currencies. Really comes down to data. They want transparency to be able to see what their customers are doing, where money is being held, how it's being spent. And we can see companies, I'm not saying they're doing it, but I know they've looked at it a few times. Organizations like Air New Zealand could tokenize things like their airpoints. And that would give them a lot of transparency over their currency. And so what's even bigger, and I don't think people realize how big this is, central bank digital currencies are here. by here, I mean China is giving out their digital currency to 10,000 people, and they've just started to do that. And so the Bank of Japan just announced, I believe, this week or late last week, that along with the Federal Reserve in the United States and the Bank of England, they'll all be working on launching digital currencies within the next year. And so we're going to be seeing this being rolled out in a really big way. And, you know, where does that leave certain businesses? For example, commercial banks have really been the middlemen between like the clearinghouses, the central banks, and end users. If central banks, you know, are issuing those digital currencies like digital New Zealand dollars, which I can hold in my wallet on my phone, and I can lend it, and I have less risk than putting it with the commercial bank, then where does that leave commercial banks in the future? And I think that'll be a big problem and question for them. So in terms of trends, this one's pretty big. Decentralized finance has been all the rage over the last 6 months. DeFi is a way to trade or create financial instruments or use financial instruments with no or with different counterparty risk. So rather than using a third party to manage custody over the transaction, you're using software to manage that custody. And so it's permissionless. It's giving huge amount of access to people globally. And so it allows people to do things like borrow and lend, and facilitate liquidity to other traders, to create financial instruments that, for example, might price people out of the market. So things like prediction markets, where you know, if you're growing a crop of onions, you can hedge those onions through DeFi, and you can do it with a few bucks. You know, to start a financial market in a you know, legacy market, it costs about $30 million in legal fees and compliance and licensing. And in the DeFi ecosystem, you know, anyone can code or contribute or even utilize the software applications that already exist. And so over the last 6 months, about $75 billion has been traded on decentralized exchanges. So a decentralized exchange is like Dacit, but without Dacit in the middle. So it's using blockchain technology to handle the trades. And so it's an aspect of DeFi, and it's an area that we see will disrupt organizations like ourselves in the future, because it does facilitate for all kinds of things like decentralized exchanges, decentralized sharing economies like Uber's. So challenges that the industry faces, and you know, it's really important to understand these challenges when you're doing your due diligence, because there's no you know, no guarantees of what's going to be successful. You know, there's always a risk that something's going to fail, and we don't know which ones are going to succeed and which ones are going to fail. So it could be the case that a worse technology that has wider global support becomes a you know, a used cryptocurrency, as opposed to one that might have better technology. And so we don't really know, but you know, we now know that what's possible, like digital scarcity is possible. So blockchain showed us what we can do in the digital space. And so we don't necessarily know whether blockchain is going to take us to the next level, but we know that it's coming. We can now have digital assets, we can have digital value, and we can manage it and program it in all kinds of fun ways. And so we know that's possible. We just don't know now what is going to work. And that's why we are failing a lot. A lot of these projects are trying everything under the sun to see what sticks. And that's why I guess another argument for looking at this industry is because of its anti-fragile nature, where it's very similar to open source software like Android. If you're familiar with Linux, in the 90s, the open source software allowed anyone to take it and build their own software and compete or take it in any direction they want. And it's created many different versions of Linux. And now it's basically the world is run on Linux software. Most phones use Android. If you use an Apple computer, its software base is Unix based. And so, by allowing it to be open source and allowing anyone to build on it and improve on it and fail a lot, we can see the things that are succeeding and building on those and improving those. And so, so there's a number of different scalability solutions that are either in the works on different platforms, are being tested, but we don't really know which ones are going to succeed in the future. And so, these present themselves with opportunities for ways to potentially create value or innovate and help solve some of these problems. For example, there's been an issue with smart contract failures in the past where people have made off with millions of dollars. But every time that is found, those exploits are resolved and new problems arise. And then those problems get resolved and the system gets stronger and stronger and stronger. And so we've had a number of solutions now to smart contract failure, and that is insurance. So there are a number of different insurance platforms that allow you to buy coverage against various smart contracts that you're interacting with. And so that will cover both things like Oracle failures and smart contract failures. And so there are already solutions that are coming out today that are solving some of the challenges that the industry is facing. User experience, that's a big one, and that's one that people have been complaining about for a long time. And I think, I'm okay with the direction that we're going in, where this is coming over time. If we go back to that scalability, we can only do up to a few hundred transactions per minute. And so with that scalability in mind, if we tried to onboard the world into digital currencies tomorrow, then everything would break and people would think that, this is crap, essentially. But if we, focus on solving these problems and scaling as more demands coming in, and solving a lot more of the protocol issues and strengthening the entire system in various systems and creating more competition and improving the network, then those user experiences will come later or over time. A lot of people don't realize the extent to which blockchains are being used today, and they're being used without people having that experience or interacting directly with the blockchain by, downloading or using a wallet. And so there's a lot to be said, a lot of opportunity for people who want to build out better user experiences, to interact and engage with smart contracts and create different products that interact with each other. And so now I want to open it up to questions.
Cool. Thank you for that, Stephen. That was quite extensive. So someone did ask earlier where DASA is based at. So
Yep. So I like to say that we are decentralized, where we do have staff in various countries, but we do have our headquarters in Auckland, New Zealand. And so we're in CBD. Feel free to come by our office. We do have staff in Australia, Philippines, Mexico, and sometimes traveling in other places.
well, that sounds so cool. And I think that's it for tonight.
Oh, wow. I can't have asked everyone or answered everyone's question.
You did. You covered it all. There's one more question. Do you have plans to offer any other products for retail investors, such as saving accounts or dual currency orders?
Yes, so we are looking at ways to allow or enable customers to interact with different DeFi smart contracts. So essentially the ability for a customer to lend stable coins or lend crypto through one of these smart contracts like Aave, and reap the reward of that. And we would essentially be managing the custody, where it'd just be a few clicks on behalf of the customer. They don't have to worry about moving their funds and interacting with the smart contract and acquiring insurance. They'd be able to do that in a few clicks. So we are looking at ways to do that. The tricky thing for us is the compliance side. So we want to make sure that we're doing it where we're not getting in trouble or providing a product where the regulators might have difficulty understanding. And that's a challenge because these products are probably going to take a very long time for the regulators to wrap their heads around.
And where are you with insured custody service?
Yeah, so we do provide insured custody service. We charge about 35 basis points a year for that service, and the funds are fully covered. And yeah, so we're happy to provide that. We tend to provide it to our institutional customers, but yeah, contact us.
Mm-hmm. And I think we can squeeze in one last question. Do we or does it have any other funding option coming around, like credit card, or do you foresee some KYC issues there?
We are looking at credit card. We have a provider that's very close to allowing us to offer debit and credit cards. One that we have is online FPOS. We just haven't enabled it yet. We're going to be adding some more Australian payment options, and we're always open to suggestions. So if there's anything that you want or would like to suggest, please let us know.
Cool. Thank you so much for answering this question, Stephen.
Thank you.